It's really interesting, Denise, to kind of sit here with Caroline. Each day we go through the blow by blow of the markets, what's driving the narrative on any given day. But even if you go back to just the start of the year, we've gone from this position of kind of worst to first to the technology sector, yet some of the fundamentals don't really back that up.
Yeah, well, that often happens, especially you can see it through history where stocks follow earnings a lot of the time, but not all of the time. And a lot of cyclical sectors can discount bad news in advance. And I think that this is what you're starting to see in technology. Now, what we saw last year of essentially downside leadership was really not just the rationale behind the fact that interest rates went up, inflation went up, a more hawkish Federal Reserve. It was also your starting point on relative valuation. So versus the overall market, technology was really in the top quartile of its history and we haven't seen anything like that back till 2005.
Yeah.
And that was really one of the key, key catalysts for the correction that we've seen last year. A lot of that valuation on a relative basis has been worked off. And we're left in this sort of muddy middle zone where technology is not the dominant sector that we've seen over the last decade, which were very supportive on relative free cash flow, but it's also not in that very, very expensive land versus the market either.
Okay, so when it is relative, where then gives up? Do we need to see the rest of the market, and by that we mean basically not the growth stocks, but more of your energy names and more of your tried and trusted value companies to get a higher valuation? Or do we need more pain to come in technology valuations?
I think that there's a lot of different ways that you can work it off. You could also have a positive catalyst, meaning that the downside in margins is less than investors actually expect. And one of the catalysts historically is something that investors might be missing out on now, which is disinflation. When inflation decelerates, what you usually have is margins better than expectations. This is true in the overall market. This is also true in technology. That's one of the reasons why you hear people say in a high inflationary environment, usually earnings recessions are less bad. It's not necessarily that inflation is good for margins, but it's because inflation is high and can decelerate that can provide a tailwind to margins that isn't typical in the rest of history.
Denise, I know you're a chart watcher. You love charts. I bring you one of my own. I got the NYSE Flang Plus Index ratio to the S&P 500 on an equal weighted basis. So you can kind of compare these mega cap tech stocks to the average stock, a kind of better comparison. What we learned this earnings season is big tech missing against consensus by high single digits. And yet, look at that performance so far this year. Will that continue based on past precedent?
Yes, from an equal weighted perspective, I think that there's a ton of valuation support in technology. And that's really the interesting thing. I think people want to debate value versus growth. And I think it's value in growth is what we might need to focus on. Like I said, when you step back and you think about the technology sector, I think it's probably not dominant leadership, but I don't think it's likely to be a downside laggard like we saw over the last year. It might be more in the muddy middle, but that doesn't mean as investors there aren't spots you can pick. On an equal weighted basis, technology looks dramatically different. We're at the floors on relative price to book, relative PE ratios, which have usually led to really strong odds of outperformance. So equal-weighted technology looks fairly different and compelling on valuation levels, as does semiconductors.
Let's just talk. It's interesting. We've been talking to those that manage certain stock exchanges, and we understand that perhaps not many IPOs are becoming thick and fast or exits in the world of technology, but maybe performance is there from some of these key companies. And we spoke to Adina Friedman, of course, and just take a listen to what she had said about her optimism.
I think that the big technology companies have huge opportunities in front of them. I think that they're leaning in as hard as they can. I think that they also are bringing the entire economy forward. So I'm a big believer in tech and big tech.
So clearly, well, I'm sure it's her job when she's overseeing the NASDAQ to be a big believer in big tech. But ultimately, Denise, what about, is it international big tech that you want to see outperform, or do we think you can be domestically focused? I'm interested in what you think as to whether dollar's going to be a driver or not going forward.
I do think that you want to be domestically focused, and it's in part because of the dollar, but it's in part because, as you know, we just heard, they're better companies. When I hear a lot of comparisons going back to the dot-com era, what's really important for investors to understand is during that time, before the recession even hit, net margins were negative. So not only are net margins positive even after the contraction, but they're still at the highest levels they've been since the 1960s in my data set. So these are much, much better companies. And that secular trend is dominant in the US. So each cycle, they've made more and more profit free cash flow. And I expect that that trend will likely continue.